Hey everyone, it's David Barnett with Advantage Liquidity Partners. This is one of a series of videos that we make about some of the most common questions that were asked. So this video is all about business valuations. We do most probable selling price evaluations on businesses. So we're able to tell people what the likely selling price will be of a small business being sold as a going concern. So this video is going to answer three questions. Who would want a business valuation? How do you do a business valuation? And what does a business valuation look like? So first of all, a little bit about me. I'm a graduate of the Williams School of Business and Economics at Bishop's University. I also have completed a program at the University of New Brunswick. I started working in the field of small and medium-sized enterprises back in 2006 when I started brokering commercial debt. So I would take care of capital leases. I would get people lines of credit, factoring facilities, which is the sale of accounts receivables. I became a business broker in 2008 and a certified machinery and equipment appraiser in 2009. Also in 2009, I became certified to sell businesses from an international body, and that's where I learned the bulk of my small business valuation work and really perfected my skills and the processes involved. I've worked as a broker and sold 36 different companies over the years, and I've been doing business valuations since 2008. In the beginning, I was working under the supervision of another more experienced business broker, and then after I became certified and started to use the tools that we have, I started doing it on my own within a couple of years of starting. So who would want a business valuation? And what we're talking about is the value for a business as a going concern. So we're going to consider something that's called goodwill. Goodwill is the value of the clientele. So basically what we do is we look at the cash flow of a business and we determine what would someone be willing to pay to buy this cash flow. What are the risk factors at play? What's the cash flow worth? So for example, if you were going to evaluate a pizzeria, you might find that because of its cash flow, someone might be willing to pay $100,000 for that business. Within the business, there are going to be tangible assets such as tables and chairs and the pizza oven and things like this. Those assets might be worth $50,000. So someone is basically paying more than the value of the tangible assets because the cash flow created by those assets is worth more than the assets by themselves. And that difference between the selling price or the market value of the cash flow and the tangible assets is what we refer to as goodwill. So the people that I do these for, number one group is probably the business owners who are thinking about or preparing to sell their business. They want to know what it will likely sell for, and they're looking for my advice on what an appropriate asking price might be. I also get business owners who are planning to grow or make an investment, and they want to do a before and after. So they will come to me with their current business financials, and they'll come to me with a pro forma showing what they expect will happen after they make a change in their business, and I can then show them what the before and after value of the company might be. So if a big investment is going to be made and there's a lot of risk involved with that, and the value of the company doesn't increase that much, sometimes people might decide that it's not worth the risk to proceed. And I also get business buyers who are negotiating or want to negotiate to purchase a business, and they are afraid that they're getting caught up emotionally in the purchase and they might be overpaying, and they want to get my opinion of what the business is worth before they finalize the purchase agreement. So how then do you go about valuing a business? And what I'm going to show you here, I'm going to zoom out a little bit. This is a tool that I use, and it's a very complex spreadsheet. You can see along the bottom here there's multiple tabs. Basically, I input the income statements, and then I have to adjust, or what we call normalize, the income statements according to a certain set of rules. So one-time charges, for instance, are removed. I normalize the owner's salary to a fair market wage. I want to know what portion of the earnings go to the owner because of the value of his time doing the work, being the manager, and what amount of profits is actually the economic profit of the business as a going concern. All these things come into play when we look at evaluation. I then do projections. So I look at the performance over the last 5 years, and then I project out based on certain assumptions that I itemize what I think is going to happen over the coming years. And then I do the balance sheets, and the final balance sheet has to be normalized as well. So in this case, we're looking at an asset sale. So things like cash, receivables, investments, money due from related parties, these things are recast or adjusted away from what is being transferred to the buyer. So then the system has a lot of different outputs. I'm able to put in benchmarking data if it's available for the industry. And then I go through and I've got access to many different methodologies. So we have income approach methodologies. There are 6 different methodologies based on income. I've got 4 different methodologies based on the market approach. So comparing this business to other similar businesses that have already sold. Those are by far the best ways to evaluate a business because we can see what risk factors other buyers saw. And because of my training, I've got access to databases of past transactions that I can look up. And then we have 2 cost methodologies, which simply are looking at what would it cost to recreate this business from a tangible asset point of view. And then there's a whole bunch of other variables that get adjusted and inputted into this report. So at the end of the day, and then I have to properly adjust for operating capital. At the end of the day, it gives me different valuation methodologies, but this isn't what you're going to see as my client. What you're going to see, if we go back here, so what does a business valuation look like? This is what it looks like. So here's a final report, and this is what someone would get after hiring me to do an evaluation. So there's a letter to the owner, talks about the purpose and scope of the project and disclaimer. You can then very easily see the historical performance and the projected performance. And here we've got revenues and we've got the discretionary earnings. I talk about the documentation that was used in the process. These are the stated historical balance sheets, so it's a reiteration of what would appear in the financial statements from the accountant. Here are the income statements. And then we start talking about adjustments, and I demonstrate the adjustments being made to the balance sheet, and then the adjustments being done to the income statements to give us what we call our normalized income statements. And then we get into the projections, and I put my assumptions here, and then I talk about what's projected to happen over the next few years. Some of the evaluation methodologies are forward-looking. Some of them are just strictly backward-looking. They're historical. But the reason that all this information gets inputted into the system is that not only can I produce an evaluation report, the most probable selling price report from the work that I did in the spreadsheet, but I can also then produce a business marketing package where a lot of this information is also pulled into. So then we've got historical consideration of earnings, talk about financing capability of the assets. I do an assessment of key value drivers. So this is one of the tools that's used to try to quantify subjective information. So how does this company relate as far as the type of business, the historical profitability, income risk, business growth, terms of sale, etc. So I've got several different factors, and then what we do is we calculate the surface area of the polar graph versus the average, and it gives us either a premium or a discount according to the other data points and valuation points. We then talk about how the MPSP is analyzed, and in this case I use 3 different methodologies. So I give the values. There was 1 income approach and 2 market approach methodologies. Not all methods are used in every case. because not all methods are appropriate for every type of business. Different businesses lend themselves to different valuation models. And then I talk about the weighting. So in this case, I put a 25% weight, a 25% weight, and a 50% weight on these different methodologies. And then we end up with our final result. Now, it doesn't end there, though, because if this is done for an asset sale, so the corporation that owns this business is retaining some things and selling other things. And that selling price doesn't really do much for you. What you want to know is, where do I end up at the end of the day after this transaction has occurred? So that's why I also create what's called a seller's closing balance sheet. And it shows that here's the cash proceeds of that transaction, but the receivables are still there, the cash is still there, the investments are still there, the note from a related party is still there, etc. So, and then we have to deal with the liabilities, and it allows someone to see where they're going to end up at the end of the day after the transaction has occurred. Then we get into an explanation of each valuation method that was used, and then an appendix, a glossary of terms. So out there in the world of people who are advising business owners, I've seen a lot of, one-page opinion of values or 3-page documents that kind of explain, here's your cash flow, and I'm going to multiply it by this arbitrary figure, therefore your business is worth X. And those types of documents are very dangerous, because not every business, every type of business is going to sell for the same range of multiples. The multipliers of cash flow are different by industry, and they're also different by size of business. So small restaurants might sell for a very low multiple. Large restaurants could sell for a higher multiple because there's less economic risk perceived with, say, a Boston Pizza franchise than there would be for a little no-name corner sandwich shop. Both of those companies could produce the same end-of-the-day cash flow for the owner, but someone's willing to pay more for that cash flow when they're talking about the Boston Pizza franchise for a whole bunch of different reasons. So this is an example, a snapshot of how we do the MPSP, how we set it's all set up in Excel. It's a standardized methodology that has a proven track record. I'm pushing hundreds of valuation projects, and of the businesses that I evaluate that end up selling, most of them sell within 5 or 10% of what the most probable selling price analysis shows before the transaction occurs. So it is a very good indication of what a business is worth to someone, and what you can expect from a transaction, or to gauge and measure yourself before committing yourself to purchasing a business. My name is David Barnett. You can always find me online at BusinessAndAssetValues.com, and I hope this answered some questions that people might have. And whenever you want, just contact me through the website or give me a phone call. I'm more than happy to talk with anyone and answer your questions. Thank you very much.